Welcome back to Turpentine VC, a podcast where we discuss the art and science of building successful venture firms, VC to VC. Today's episode is with Will Summerlin, managing partner at Autopilot. In this conversation, we cover AI's impact on various industries, the importance of strategic investments in potentially monopolistic markets, and the evolution of AI models. Will is also a host at Turpentine with the Autopilot podcast. We'll include a link in the description so you can check out his interviews with AI founders backed by Benchmark, Greylock, YC, and more.
Will, welcome to the podcast. Thanks so much for joining.
Yeah, thanks for having me, Erik.
Excited to talk about Autopilot. Let's get into the new fund. First, just break it down for us. What is the thesis of the new fund? Why this and why now?
Yeah, it's a great question. I think if you look at returns in venture capital, they often follow the start of a super cycle, right? We saw this with cloud and companies like Twilio and CrowdStrike. We saw this with mobile and companies like Uber. And I think we're definitely at the start of a new super cycle with AI. And our thesis, if you go back and zoom out to a 30,000 foot view, we're getting to a point where AI can do cognitive tasks that humans do not only faster and cheaper, but oftentimes a lot better. Right. I think the origin of this and what caught most people's attention, if you go back several years, was AlphaGo, right? And DeepMind's program beating the best Go player in the world. And it was a really hard game for computers to learn and compete in. But the way that it beat the human was really interesting. It didn't just play a human strategy. It basically realized like humans have been playing in this small box of possible strategies. There's this giant box outside of that of potential solutions and potential ways you can play the game. And it went and explored all these different paths that humans had never thought of. And so, it was able to execute that strategy and beat the best Go player in the world. And now we're seeing that across a lot of other domains. If you look at Tesla's full self-driving capabilities, it's 10 times safer than a human driver, and it's only getting better. I can continue on down the list of all these ways that AI is better than humans at many complex tasks. But if you think about the opportunity set, we currently pay humans $32 trillion a year to write software code, to review contracts, to do these tasks that AI can increasingly automate. And so I think we're at the start of a new super cycle where the technology, if we paused where it is today and it got no better, it would still be an incredible super cycle, right? If you look at accounting, for example, we looked at an analysis, about 50% of common accounting workflows can be automated with technology as it is today. But it's not going to stay where it is. It's going to continue improving at an exponential rate. So if you think about the opportunity set within the next decade, I think it is going to be perhaps the most value creating super cycle in the history of modern society. And so based on that, it's a pretty good time to launch a new firm and be investing in startups.
Sam Lessin came on this podcast and he talked about why he's bullish on AI. He's bearish on it for startup investment opportunities, especially at seed, because he says incumbents will take on a lot of the advantages. It's going to make the players with data much better, have much more capabilities and be able to use that data. And then also the foundation models themselves, and it's kind of too late to invest in them or too expensive to invest in them. And then just more broadly, everything is priced very, very highly. What say you to that?
I actually agree in a lot of ways. I think so. I was at a firm called ARK Invest prior to launching Autopilot, Kathy Wood's firm, and ARK was among the largest shareholders and a lot of big companies like UiPath and Square and Twilio, and got to know these businesses really well. And especially the founder-led ones, they know the opportunity. They have the capital to invest and compute, right? And we've seen scaling laws mean that the larger a model is, the more compute you use to train it, the better it performs. If you're a startup, investing $100 million in a GPU cluster is pretty cost prohibitive. But if you're a big company that's doing $3-5 billion a year in revenue, like you can make that investment. They also have proprietary data, to your point, right? Not only the data to train these models, but also the feedback loop. They have instant scale. So if they roll this out to 100,000 customers or 100,000 users, they're automatically instantly capturing reinforcement learning with human feedback from 100,000 people. So the incumbents really do have the opportunity to win. And in most markets, they should win. I think it really comes down to a market by market discussion of how aggressive, innovative, and competent are the incumbents. Would I compete directly against CrowdStrike? Probably not, right? Like, would I compete directly against, against Tesla? Probably not. But there are a lot of markets that AI is going to touch and transform where the incumbents are pretty stale, right? They're not innovative companies. They don't know what cloud is. So if you look at, for example, manufacturing, and you look at a subset of manufacturing called tool and die making, where companies basically build the molds and the dies that go into a factory to produce bumpers and lots of other parts. That's a really stale industry. Like their technology is probably 30, 40 years old. And they have some software, but it's like designed in the late 90s. And so are those incumbents that don't understand technology going to all of a sudden innovate and hire a bunch of people out of DeepMind? Probably not, right? And so I think there are a lot of these stale markets where the advantage really does go to startups who can think from first principles, who can recruit great talent, and who can build AI native solutions. And so for us, like we think that innovative incumbents are in the advantage position, and a lot of these markets, I think that people see as obvious, like AI copilots for sales or an AI accounting startup, are probably going to be pretty crowded on the startup side, and also like be pretty competitive from the incumbent side. But if you go look at markets like tool and die making, the question around like startup versus incumbent, I think, becomes much more clear where the startups definitely have an advantage.
Yeah, that's well said. Let's dive into that a bit further. You shared some markets that you bearish on for, or somewhat bearish on for new AI startups because the incumbents are strong, like security with CrowdStrike or self-driving cars with Tesla. But then you also said some spaces that'll be crowded, like AI sales and AI accounting, but you some opportunities in subsectors of manufacturing. Why don't you flesh out? Let's go into more markets where you're bearish and more where you're bullish. And I also want to plug your great podcast that you do with us, Autopilot, that gets into some of these spaces as well.
Yeah, it's a great question. So I think there are two ways to look at this. The first is, what does the competitive landscape look like today, and what will it look like 5 years from now? And I think I sort of believe like the Peter Thiel-ism of competitions for losers. And if you look at a market like AI copilots for sales, really useful technology. Like I can very clearly see the value, and I think it's going to grow very quickly, that market. But there are quite literally 1,000 startups and like a dozen innovative incumbents competing for the same dollar. And so when you have that sort of dynamic, your customer acquisition cost goes up and your pricing power really starts to erode. But if you look at a market like injection molding and tool and die making, the incumbents, going back to what we were talking about a minute ago, they're not very innovative. And there are like one or two interesting startups in that market because it is really complex and it's hard to underwrite. And, it's a much harder problem to solve and a much harder technology stack to build than just like building an AI copilot for sales. It's going to grow 500% year over year out of the gate. So I think that's criteria number one, is what does competition look like today and what is it going to look like in 5 years? Criteria number two is pricing power. And, the most valuable companies on earth have structural competitive advantages that compound with scale. And you can go back in time and look at Standard Oil, right? Standard Oil benefited from like the classic economies of scale, where they had all these advantages so that as they grew and got bigger, their costs got lower. And so they got to a point where, JD Rockefeller could sell oil profitably at a price point that would put all of his competitors out of business, right? His competitors at, say, like the arbitrary number of, $1 a gallon. That was profitable for him because his costs were so much lower because of his scale. But the competitors would be losing money at $1 per gallon. And so he had economies of scale, right? It created a monopolistic outcome. You look at Meta, right? The Facebook ecosystem, they have network effects, right? So the more people that they add to the network, the more value the network creates for everyone on the network. And so you have this like compounding moat. And so I think we look for companies that can essentially monopolize an industry and develop this pricing power over time. And so whether that's network effects or economies of scale, that's great. I think with AI, you have a new form of a compounding moat and reinforcement learning with human feedback, where the more feedback you get from usage of your models, the better you can tune those models and train the next generation. The better your models, the more people you attract. More people you attract, the better the models become. And so I think you do have this new kind of compounding moat that we see in some cases with AI. But those are the two criteria we look for. So in a market, is it not very competitive? And can one company essentially monopolize it by developing some structural competitive advantage? So that's the framing. And I guess to give a couple examples of where we see opportunities and counterexamples of where we don't, I think AI copilots for sales is an example of an area that we don't see a lot of opportunity. I think like horizontal writing assistants is another where we've seen a lot of startups that essentially are building wrappers on top of GPT-4 and helping you write paragraphs or write marketing copy. Well, guess what? Like there are hundreds of other startups doing that. They all have access to the same underlying technology. And now Microsoft, Google, Notion, every word processor also is embedding those features. So like those are markets that don't really meet the criteria. I think where we get more excited, we mentioned injection molding as an example. I think that's an area where there's very clearly a need for automation. And so the labor force in tool and die making has declined 50% in the last 25 years, while the market's grown at an 8% CAGR. So you really need automation. It's clear that there's not a lot of competition. The incumbents aren't going to do it. And there are a couple startups that are interesting. And you can see how economies of scale take hold here. And the company that wins develops pricing power over time and has sort of a self-fulfilling flywheel. So I think for us, that's really interesting. We're spending a lot of time in industries that are maybe today a little bit more services driven. So like revenue cycle management within healthcare, that's a huge industry. And right now it's pretty much done by, like all the work is done by humans. And we've done some work here and like probably 70% of what those humans do today can be automated with off-the-shelf AI technology. So you can see how there's very clearly a story there. And the incumbents there run services businesses. They don't know how to build technology. Like that's an example of an area we're really excited about. And I can keep going down the list, but I think we're looking for more of these stale industries where the incumbents can't compete. There are a couple startups and you can develop pricing power over time.
Yeah, I love that framing. Maybe give us one or two more, or maybe I'd position it this way. Do you have a request for startups, or in the sense of for if you could sort of guide really talented entrepreneurs with the right set of skills and right set of relationships to work in any specific space or spaces? What's another space where you see opportunity that you'd want a founder to go pursue and then call you?
Yeah, it's a great question. I think we're getting really excited about things that touch the physical world. If you look at the economy, like the global enterprise software market today is $1 trillion. So companies spend $1 trillion on software. And a lot of the AI startups that we see are competing for some IT budget, right? They're selling software to incumbents. And I think, that's fine. Like there's going to be some opportunities there. Some of those markets will be too crowded. Some of those markets will find pockets of opportunity. But I think one of the more interesting strategies we're seeing in AI is not to sell software to the incumbents. It's to vertically integrate AI and compete with the incumbents. So we talked about revenue cycle management. Like instead of trying to sell AI to those legacy companies that don't understand technology, just build a new revenue cycle management business from the ground up and make it AI native, right? And you'll be able to run it at probably 60% gross margins, not 85% gross margins, but you can build a really big business. And I think this is sort of, AI kind of shifts the opportunity set here. And a lot of investors, I think, still are dogmatic about only investing in software and like afraid of services, which I think is crazy. I think a lot of these markets you can really attack and to some degree monopolize if you're willing to build a business that has some services component, but really relies on AI to automate most of the work that would otherwise be done by humans. So I guess my request for startups is if you're a great entrepreneur and you're looking at the opportunity set on the horizon, like look at these industries that are relatively stale, that are services heavy, where you can use AI to automate a lot of what humans do today. And don't be afraid to vertically integrate and compete with the incumbents.
Yeah, that's well said. More broadly, what's your take on the broader sort of the wrapper debate in terms of where will value be accrued to the foundation models, or where independent startups will be allowed to sort of to prosper and not get disrupted, not only by incumbents, but by the foundation models themselves? What's the right way of thinking about that?
Hey, we'll continue our interview in a moment after a word from our sponsors. Over 100 startups launched today. Do you know who they are? If you're not seeing interesting startups, none of your downstream processes matter. How you source deals at the earliest stages could be your most consequential investment. Harmonic is the most complete startup database, finding new companies as soon as they incorporate and tracking them through IPO. You can create a search tailored to your investment thesis. In one search, filter over company data, including venture stage, industry, and geography, founders and operators' backgrounds, and traction metrics like headcount changes, social media audience, and web traffic growth. Importantly, Harmonic instantly surfaces warm connections to help you connect with founders. The results are delivered on autopilot, wherever you most need them, over Slack, email, or via API directly into your CRM, integrating seamlessly into your software stack. Learn why Craft, Bedrock, NEA, and hundreds more trust Harmonic's data by visiting harmonic.ai or use the link in the description. Make sure you mention our podcast, Turpentine VC, during your demo. Hey all, Erik Torenberg here. I'm hearing more and more that founders want to get profitable and do more with less, especially with engineering. Listen, I love your 30-year-old ex-FANG senior software engineer as much as the next guy, but honestly, I can't afford them anymore. Founders everywhere are trying to turn to global talent, but boy, is it a hassle to do at scale, from sourcing to interviewing to on-the-ground operations and management. That's why I teamed up with Sean Lanahan, who's been building engineering teams in Vietnam at a very high level for over 5 years to help you access global engineering without the headache. Squad, Sean's new company, takes care of sourcing, legal compliance, and local HR for global talent so you don't have to. Their engineers follow your process and use your tools. They work with React, Next.js, or your favorite front-end frameworks. And on the back end, they're experts at Node, Python, Java, and anything under the sun. Full disclosure, it's going to cost more than the random person you found on Upwork that's doing 2 hours of work per week but billing you for 40. But you'll get premium quality at a fraction of the typical cost. Our engineers are vetted top 1% talent and actually working hard for you every day. Increase your velocity without amping up burn. Head to ChooseSquad.com and mention Turpentine to skip the waitlist. That's ChooseSquad.com.
I think LLMs specifically are going through some level of commoditization, right? And we've seen this with like Llama 3. It's almost as good as GPT-4, but your inference costs are going to be 10 times lower if you're using an open source model like Llama 3. And so, like, is it good enough for most use cases? Probably. I think what we're also seeing is a lot of companies are opting to train smaller proprietary models for very narrow use cases. So if you're trying to build an open-ended chatbot that can answer any question about any subject, you probably need to use a big model like GPT-4 or Llama 3. But if you're trying to solve like a very narrow subset of tasks, you don't need GPT-4 or Llama 3. It's sort of like, putting 1,000 horsepower in a golf cart. Like, it's kind of unnecessary. And so if you end up training a smaller proprietary model that's more domain specific, your quality of answers will be the same, maybe a little bit better, but your inference costs are going to be a lot lower, like 100 times lower in some cases. And so, instead of spending, $1 for an answer, you'll spend a penny for an answer. And I think that really matters as you get to scale. The inference speed can also be a lot better, right? And so instead of waiting a full second for a response, you can get a response in milliseconds. So we're starting to see companies train these smaller proprietary models that are domain specific. So I think that, like, those two things together, the open source phenomenon combined with this trend towards domain specific models, is going to create some headwinds for the really big closed source models. I think there's an argument that changes a little bit as we move to multimodal models and eventually AI agents. And we talked about scaling laws for a second a while ago. There, as we move towards like AI agents and multimodal models, there are really three things that matter. The first is talent, right? You need smart researchers who can actually train these models. The second is compute. So scaling laws hold that the more compute and more data you use to train a model, the better it performs across a wider range of tasks. And the third is data, right? You need some level of proprietary data, especially as we move into like multimodal models where you need a lot of vision data, a lot of audio data. So I think as we see the shift from LLMs to multimodal models and eventually to AI agents, there's an argument that the closed source model providers will have some advantages. And if you're Meta, maybe you can spend $100 billion training a model and open source it. But Meta might be the only company in the world that can do that. And so I think if their priorities shift in any way, I think it creates an opportunity for the foundation model providers as we move from LLMs to multimodal models and agents.
Yeah. That makes sense. Have you looked into any of the companies trying to be sort of dominant, like Lindy AI or any of the companies trying to be agents, directly?
Yeah, I don't think we're there yet. The opportunity is incredible. I think one way to look at this is like, look at UiPath. UiPath has built an incredible business with robotic process automation, which is sort of like the early version of what an AI agent looks like. right? They have technology that can automate pretty simple processes, like taking data from an application that runs on a mainframe and moving it into a modern SaaS application, right? Doing some screen scraping and other techniques. And that version of RPA is like somewhat cumbersome to implement. It can be expensive to implement. It can break pretty often. But they went from 1 to 600 million in revenue in 5 years with this technology, which is incredible. And so I think that shows the demand for like AI agent like capabilities. And as we move from where we are today to functional AI agents in the next couple of years, I think that they're going to be a lot easier to implement than RPA. They're going to be able to do a much wider range of tasks than RPA, and they're going to break a lot less frequently than RPA. And so I think if we look at that 1 to 600 million growth trajectory in 5 years, like that's really just scratching the surface on the opportunity for AI agents. But I think given what we just talked about, like it's really going to come down to proprietary data and compute, as well as some level of talent. And I think, if you're a startup, like it's going to be challenging to compete with, the big guys, right? OpenAI, Meta, XAI, who are going to have access to probably a lot more data, but certainly a lot more compute. And so unless you're raising billions of dollars out of the gate to go build giant GPU clusters and find ways to acquire a lot of proprietary data, it's going to be difficult. You're going to be facing an uphill battle.
If you could have done OpenAI or Anthropic a round or two ago, might you have? Are you long-term bullish on these companies that you could have developed the conviction there, or unclear?
Yeah, I mean, look at Arc. We invested in Anthropic pre-revenue, and that investment's done very well, right? And I think the company's crushed it. I mean, I think they've grown from like 0 to like 350 in ARR, and 350 million in ARR in like 18 months, which is insane. And so they're crushing it. Like really smart team, and they're focusing more on the enterprise. And so what they've realized is like a lot of enterprise customers, they want to fine tune their models. So they want a base model like Claude 2, and they want to fine tune it on their own enterprise data and sort of host that within their own enterprise environment. So I think Anthropic has found an interesting niche within the enterprise. OpenAI, their structure scares me. Like we saw this governance issue that happened earlier this year, and there's still a lot of unresolved questions around that. So I think they've crushed it. Like Sam Altman's obviously, an N of one founder or CEO, and I think there are a lot of reasons to be excited about what they're doing. And I think they're also aggressively pushing into multimodal models and AI agents. And so whether or not LLMs become commoditized could be less relevant 5 years from now for OpenAI's story. But I think given some of the other structural challenges there, I think, we consciously sort of looked at that and said the risk reward here maybe doesn't make as much sense.
Yeah, that makes sense. Is it fair to summarize your AI thesis in the sense that it will both make sort of the most skilled people much higher leveraged, but at the same time it will replace labor for a large percentage of people, and thus make businesses just much more effective and productive, and especially in industries that don't have that much of it, there's massive opportunity there.
Yeah, I think going back to history, right? We talked about this just before we started recording. Like it's really hard to predict the future, but often the future rhymes with the past. And I think we can go back in history and try to draw parallels to what's happening today. Going back to the Industrial Revolution, the tractor increased the productivity of farmhands 17-fold. And you would think like, okay, well, farms will just hire 17 times fewer people. But that's not what happened. The individual became 17 times more productive. And humans are creative and find, in a capitalist society, find ways to make those people make that productivity boost generate more and more revenue and eventually more profit. So what happened is like the wage rate for those people went up, right? Because they were able to produce 17 times more goods or 17 times more harvest in an hour. I think we're seeing the same thing happen a little bit here. And if we look at software development as kind of an early indicator, we're already seeing AI make software developers 5 times more productive. And so I think if you go to most companies, like think about a startup, if you have developers that are 5 times more productive, are you going to hire 5 times fewer developers? Or are you going to write 5 times more product, right? Or develop products 5 times more quickly? And I think there is this trade-off or this question of like, is the job category a cost center or a revenue center, right? And I think you can argue sales, for example, is certainly a revenue center. Like if your salespeople become 5 times more productive, you're not going to fire 80% of them. You're just going to generate 5 times more revenue, which is awesome. I think the same could be true with like software developers to some degree, right? They write product faster that allows you to unlock more pockets of revenue more quickly and compete with others more effectively. But then I think there are cost centers, right? If you look at compliance within a company, or you look at call centers, like they're purely cost centers. And if you can reduce your costs by 80% by automating most of what humans do today, that's what you're going to do. So I think we will see some job categories like customer support probably shrink, but I think we're going to see these revenue centers just become a lot more productive. And I don't think people will get laid off. I think people will actually end up earning higher wages because of their productivity increase.
That's well articulated. I want to zoom out and have you describe the more fund mechanics and fund strategy in terms of how you thought about where to play, because it's much earlier than you're playing at ARK, or ARK was much wider, of course. And so how you thought about sort of that narrowing to some degree, how you thought about fund size, et cetera. When do you get into the sort of mechanics of Autopilot?
Yeah, for sure. So I can't talk about our fundraising plans. I've been slapped by our lawyers for doing that. So can't talk about active fundraising plans, but I can talk more broadly about where we see the opportunity set. At ARK, we had a lot of flexibility, which was great. We were in the public markets, investing in the most innovative public companies. On the private side, we were investing from pre-seed to pre-IPO, so stage agnostic, and really got to flex into where we saw the opportunity set. And I think that was great and had a lot of advantages. For Autopilot and kind of looking at our skill set, where we see the opportunities, we're really narrowing in on Series A and Series B. We think that the pre-seed and seed market has gotten really crowded. There were 5,000 sub-$100 million funds raised in the last 5 years, which is crazy. So there's this flood of capital at pre-seed and seed. And the Series A, Series B funds haven't kept pace. We've seen these mega stage or these mega multi-stage funds like Andreessen just raised. And that's great, right? And that brings more capital to the ecosystem. But I think boots on the ground, we do see a lot of opportunity at Series A and Series B. From a valuation standpoint, for AI specifically, we see a lot of seed companies raising at kind of 5 on 25 with no product, no revenue, with just an idea. And then they'll turn around and raise a Series A at maybe 70 or 100, but they're already generating 2 or 3 million in ARR. And the loss ratios at Series A and Series B are much lower than pre-seed and seed. So there's a significant de-risking that happens in that step up. And I think that to us is more attractive right now. I also think given our skill set, we're predominantly public market investors and did a lot of growth pre-IPO stuff. It's easier for us to underwrite a company that's doing 1 to 10 million in revenue than it is to underwrite 2 guys in an idea. And I think there are a lot of great pre-seed and seed investors who can look at 2 guys with an idea and do a very good job of determining who has a shot and who doesn't. I don't think we have any alpha at that stage. But if you give me a business that's doing 1 to 10 million in revenue, I can do a pretty good job of telling you whether or not it has a chance of becoming a big public company. So we feel like for our skill set, that's kind of where the best place to play is. I think the other consideration is just from an AI standpoint, going back to what we were talking about markets, we like markets where the outcome is monopolistic, where one company can really dominate and own most of the market. And I think at pre-seed and seed, if you have 3 or 4 companies, it's impossible to determine who's going to win. I think by Series A, by Series B, we have enough signal to make a pretty confident bet. And if we're looking at 3, 4, 5 companies in a market, I think we have enough data by Series A or Series B to confidently say, this is the company that we think is probably going to end up winning this market. And so given we're looking for more of these monopolistic outcomes, we feel like it's a better place to play. And I'll also add one more thing. What's crazy is there's still 1,000x upside. It's even Series B. Snowflake raised a round at a 75 million post, a Series B at a 75 million post. And as of a couple of weeks ago, their market cap was 75 billion 10 years later. And so it was 1,000x in 10 years. And so if you get into the right companies, you still have 1,000x upside at Series A and Series B, but with much lower loss ratios.
Yeah. And so implicit in that sort of belief that these outcomes will continue to be bigger, even get bigger. Are you bullish on the asset class then? Hey, there's just going to be more bigger outcomes, and thus, even though there's more capital, the best players will continue to do like very well or exceedingly well because the outcomes will just be bigger.
I think there are a couple dynamics. I think number one, that the AI supercycle is going to create a ton of net new enterprise value. We've done some calculations here, and it's hard to say with any level of precision exactly how much net new value it's going to create. But I think there's a strong argument that if you think about that 32 trillion in labor spend, I think AI is going to automate a lot of it, or it's going to make humans 10 times more productive and capture some of that value. I think you can make a reasonable argument that AI companies are going to go from collectively maybe 50 billion in revenue today to probably somewhere north of 3 trillion within the next decade. And if you back into what the enterprise value on that is, we're probably talking 25 to 30 trillion in net new enterprise value that will be created within the next decade. And I think the dynamic we're seeing is that companies tend to stay private a lot longer, right? Traditionally, you would go public at like less than 100 million in ARR, right? If you go back to the 90s or to the early 2000s, like, man, when you hit 100 million in revenue, you're a public company. Maybe you raise a Series A, a B, maybe a Series C. Like, that's kind of late, but maybe. Now we look at companies like Scale that's growing 200% a year over year at $1 billion in ARR, right? Look at Databricks, they're growing 50% year over year at $1.5 billion in ARR. Look at SpaceX that's valued at north of 150 billion. All these companies have opted to stay private a lot longer. And I think that phenomenon is going to persist. And so as AI creates a lot of new opportunity and a lot of net new enterprise value, and companies choose to stay private a lot longer, I think the asset class is going to grow. And Preqin is an interesting sort of interesting research group focused on the private markets, and they did a study just basically looking at LPs and demand for the asset class, and they forecasted. I'm trying to get the exact numbers right, but they forecasted the asset class is going to grow from, I think, roughly $1.5 trillion to over $4 trillion within the next 4 years. And so if you go talk to LPs, there is a ton of demand for the asset class, historically been access constrained. And if you put all these ingredients together, I think the asset class will certainly continue to grow, which is great for founders, right? Founders that have more optionality, more capital to work with, I think it's all a net positive.
It's great for founders, but is it great for VCs, the people who really matter? I'm just teasing.
No, it's a great question. Like returns will probably get compressed to some degree. I think the days of like easy 40-50% IRR funds are not going to hold for the next decade. I think given the super cycle, like there is a ton of opportunity, and we'll see a lot of 10x plus funds, but it is a lot more competitive, and I think you got to find your niche and carve it out. But yeah, the days of like easy layups where you can just like sit in your office on Sand Hill and have the best founders come beg you for money, like those days are over.
Yeah.
Like you gotta compete, you gotta be aggressive to win.
So I always find it disingenuous when VCs complain about the amount of capital in the ecosystem, because they'll use arguments like they're saying that it invites too many tourists, people who don't really want to be founders, and a constrained environment was better for surfacing the best folks. And I think there's some truth to it, but we can't be at the optimal maximum of all the people who could potentially be successful founders actually starting companies. And so it feels like just more shots on goal is probably better for the ecosystem, even if there is some drawbacks, namely being for VCs that it's harder to pick, it's harder to have a monopoly, et cetera.
I totally agree. I think the other reality that a lot of people like either don't want to admit or don't recognize is like most VCs actually aren't very good investors. Like most VCs just like have this herd mentality, and there are certain markets that get hot and everybody chases these markets, and that's why there are 1,000 AI sales co-pilots, right? Like they're all growing very quickly. The market got hot, and like everybody felt like they needed an AI sales company in their portfolio. And I think if you're taking more of a research-driven approach and you're okay being on an island of one, being non-consensus and ahead of the curve, like I think there's always going to be alpha. But I think the reality is like a lot of people like to follow, and very few people like to be truly non-consensus or truly contrarian before something's obvious. I think that's where the alpha is. And that's not only true in this asset class, like it's true in all asset classes, right? If you're looking at, I won't comment on like NVIDIA's future outlook, right? Because like there's good arguments on both sides, but like, if you're just now discovering NVIDIA, like you're probably too late to the game, right? If you discovered it like 4 years ago, it's all scaling laws and like all that coming together, like, man, you would have crushed it. So it's true across all asset classes, but I think venture specifically kind of falls into this herd mentality more than many other asset classes.
Yeah, I heard some allocators just say things like, "Hey, because it's a time of incumbents, I'd rather just put the money in companies like NVIDIA or like Microsoft or like some of these other bigger players because they're just more bullish on that relative to the venture opportunities, even at Series A or Series B, et cetera." How do you think about that sort of opportunity cost or decision?
I think it's totally fair. And, I think a lot of allocators are like pretty sophisticated investors. And a lot of people in venture, didn't come up as professional investors, right? Came up as founders or worked at a startup and kind of went from being an operator to being an investor. And I think there are a lot of really smart people that made that transition and they can be great value adds to a cap table. But I think compared to the LPs, like most LPs that are now CIOs at a pension fund or CIOs at a large institutional investor, like they came up as professional investors, right? They probably have a better understanding of market cycles and economics than most people in venture. And I think rightfully they look at what's happening and they say, man, a lot of these markets are really crowded. Like valuations seem a bit irrational, and the incumbents probably do have an advantage. Like, why would I allocate capital to, a fund that's going to go, invest in these like highly crowded markets where valuations are irrational when I can just put my money into name whatever innovative public incumbent, have that money not locked up, not pay fees on it, and probably still capture some of the upside. So I think it's like a totally justifiable view. And I think the challenge is like, how do you find the pockets of opportunity and in the private markets where they're not crowded, where it goes back to what we were talking about earlier, right? Where they're not crowded, where a company can essentially build a monopoly and build a durable multi-billion-dollar public company. And I think, if you find those pockets of opportunity, it's great. But if you're just like incinerating capital on whatever the cool thing is, like I understand why they're skeptical. And you have to look at what happened over the last few years. Like most venture firms were not good stewards of capital in 2020, 2021, and beginning of 2022. And LPs got caught up in it too, right? Everybody got excited about the hype cycle, and LPs have a very recent sort of, burn or flesh wound looking back at 2020, 2021 and seeing their capital get incinerated. And like rightfully, they're a little bit more cautious now.
I sometimes hear people say things like 90% of venture capital firms don't return any money. Do you actually know the stats?
I don't know the stats. I had this conversation with an LP recently, and I think their view is like, you have to be really bad to not return 1x. Like most funds can at least return 1x, but it is just like startups follow a power law, like funds follow a power law too. And a lot of investors, if you're an LP allocating to this asset class where your capital is going to be locked up for 10 years and like there's a higher variance in returns, like you really want at least 30% net IRR from a fund investment in order for it to be worthwhile. Like you can go park your money in buyout and consistently get 20, 25% net IRR with like relatively little variance between funds. And your capital is only locked up for 3 or 4 years. And so in order for venture to be more attractive than buyout, like you really have to be producing at least 30% net IRR, and you should be producing more than that. And so I think there are very few firms that actually do that consistently. And that's where the challenge is for LPs is like, how do you find those firms? And the firms where it's obvious, like Benchmark consistently produce 10x funds, like you're not going to get access. I talked to an LP at a big endowment recently, and the CIO before him had pulled out a Benchmark in '08. And he was like, it was stupid. Like we're never going to get back in Benchmark, right?
Right.
And so I think after like 2 or 3 funds, when it's obvious that a firm has the potential to consistently return 30% plus net IRR, like you're not going to get access. So the challenge from LP's perspective is like, how do you find these funds in fund 1, fund 2, when you could build a relationship and get allocation, but be correct in your decision. So it is challenging.
Yeah. That's really interesting. I want to return back to something else you said earlier in terms of you look for markets where it would be clear there'll be a monopoly, a monopolistic market. How do you what are the clues that help you determine whether a market will have a big winner as opposed to a fragmented market?
Yeah, I think it comes down to two things. I'll say it comes down to three things. The first is competition, right? It's better to be in markets that are just less competitive from the start. The second is the structural competitive advantage. Like, what moat do you have that will compound with scale? Whether it's economies of scale or network effects or this data feedback loop we were talking about with AI, you have to have something that makes you harder to compete with as you scale. If you don't have that, then even if the market starts off uncrowded, and 3, 4, 5 years when it becomes obvious that you found a gold mine, like others are going to rush in and compete. And if you don't have that structural competitive advantage, like your market will get commoditized over time. I think the third is the team. And, I think if you look at a market like electric vehicles, like there is some structural competitive advantage there around like economies of scale and vertical integration, all of that. But man, like I wouldn't want to compete against Elon, right? And I think you have founders and you have teams in some markets where they're just going to move so quickly and they're going to be so aggressive that it's going to be really hard to compete with them. They're just going to roll over you. And so I think if you find a market that has those three things together, where you have a company that's led by an incredible founder and has a great team around him who is just super aggressive and is going to win and roll over anything in front of them, combined with some structural competitive advantage that makes them harder to compete with as they scale, and very little competition starting out, like that's a really good market. That's probably a good place to invest.
Yeah. And I want to go back to also another things, fund size. I know you can't talk about some specifics in terms of your fundraising process, but let's generalize it. What advice might you give to another fund manager in terms of how to think about their fund size if they're also playing in the Series A, Series B space? Because it seems like we see a really broad range.
Yeah, I think there's a sweet spot where your fund is small enough that you can be collaborative. I think if you can be flexible and collaborative and get away with a co-lead check or even a follow check at Series B, follow checks at Series A are pretty hard, or do a bridge round. Like I think that gives you more optionality. And if you can get to the ownership that you need with a smaller check, that's great. I think at the same time, you also want to have enough dry powder where if you have the opportunity to lead around, you should have that capability, right? So if it's leading an A or writing a decently large check to lead a B, like there is a sweet spot where you can sort of flex into a lead check, but also flex down into maybe a slightly smaller check and still get to ownership that's meaningful for you. So like at least for a fund one, fund two, when you're building the brand, I think that's the right strategy. And then I tend to like follow this Warren Buffett philosophy of like there are a lot of good opportunities, but there are very few great opportunities. And I think if you're building a diversified portfolio of like 30 or 40 companies, like you're probably gonna have pretty mediocre returns. Like your maybe the variance of returns will be a little bit lower, but your returns are going to be somewhat mediocre. I think that's that's sort of a weak way to play the game. Like my view is you should have a concentrated portfolio, right? Have 10 or 15 investments and really only pull the trigger when you have super high conviction that it's an incredible company and the valuation makes sense. And the reality is there just aren't that many of those opportunities. Like you come across a few a year where you're pounding the table and saying like, absolutely, we have to do this. And I think having a concentrated portfolio forces that discipline and forces you only to pull the trigger when you have that sense of conviction. And so I think combining those two things together, you can sort of do the math to back into the portfolio size or the fund size that makes sense. But I think that's the right approach. Like I've talked to a lot of people who are just like kind of pick a number out of a hat, like like other funds are like 200 million, so I'll raise 200 million, and that's not the right approach. But I think if you can combine those elements, you'll probably end up in a pretty good place.
It's interesting that you say 10 to 15 because I see more firms do things like 20 to 30. So yours are really concentrated. How do you pick that number as opposed to more within the 20 to 30 range?
I think it depends on the stage. If you're doing pre-seed where loss ratios are a lot higher, you do need a more diversified portfolio. You need more shots on goal because you're going to be wrong more of the time. I think if you're doing like Series A, Series B, where you're investing post product market fit, where companies are already working. It's not a question of like, can they build something that people want? It's a question of, okay, it's working. How big of a company can this become? Your loss ratios are a lot lower. And there's a lot of data around this. And so if you're building a portfolio post product market fit, where loss ratios are lower, you can get away with a much more concentrated portfolio.
Cool. With that, gearing towards closing, you've talked a lot about AI, but you also have a FinTech component to the firm. Why don't you talk about that as well, and where you see opportunities, or where you're excited, where you're looking?
Yeah. So my co-founder, Max, led FinTech coverage at ARC. And so he knows FinTech more than most people that I've ever met. And I think as we look at the opportunity set in FinTech, a lot of it, most of it has an AI bend to it. Financial services, along with healthcare, is a industry sort of ripe for automation. There are a lot of manual processes. There's a lot of inefficiency that AI can solve. And I think financial services has gone through the cycle where initially you had a lot of these processes handled by, humans in tier one cities, right? In New York and LA and other places that were expensive, where the labor was expensive. We saw them move to like tier three cities in the US, build up labor forces there to review loan agreements and deal with compliance and do all sorts of back office stuff. Then we saw that get outsourced. And now you have a lot of document review, compliance work, even some legal work that's been outsourced to India or places where the labor cost is lower. And I think what we're going to see next is that outsourced labor is going to get replaced with automation, with AI. And so we see a lot of opportunity in financial services to automate work that has historically been outsourced. And I think that's true across insurance. It's true across financial services, banking, and we see a lot of those opportunities in healthcare as well. And so I think it's one of the areas that we're focused on because it is one of the markets that we're most excited about from an AI perspective.
Yeah. And let's use that as a segue to close and plug your great podcast, Autopilot, which you've started recently, and you do deep dive interviews into, well, so far it's been with founders in different subsegments of AI, whether it's legal or manufacturing or working with creators. Why don't you share more about what's upcoming with podcasts and what you're hoping to do?
Yeah. So, going back to the crowded versus uncrowded markets, I think we see every day companies automating various parts of the economy. And a lot of these opportunities are in industries that most people don't know a lot about, like tool and die making. And so the idea of the podcast is to bring in founders who can share more information about these industries and the automation opportunities and how they're tackling them. At the same time, I think we're going to bring in some investors who we think have good 30,000 foot views of where the opportunity set is and what's happening in the ecosystem. And then occasionally we'll bring in historians to provide that historical perspective. And as we talked about earlier, the future is hard to predict, but it usually rhymes with the past. And I think particularly with AI, we see a lot of parallels with the Industrial Revolution. So the idea is combine interesting stories about how founders are automating these big stale markets with kind of 30,000 foot views of what's happening overall in the ecosystem, combined with some historical perspective of what happened in the past and what might happen in the future.
If you're a founder or investor or anyone looking to get smarter on these verticals, I highly recommend listening. It goes very deep. And if you're building something interesting in any of these spaces that we've talked about today, you'd be very lucky to have Will and Max and Autopilot on your cap table. Will, thank you so much for coming on the podcast.
Thanks for having me, Erik.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you liked the episode, please leave a review in the Apple Store or rate us on Spotify.